This was the most popular panel. The most popular answer was understanding the differences between the various stablecoin designs and really understanding why the designers of these coins have made these specific choices. So we're really excited to dive deep into this topic. Obviously, this has been in the news recently. There's been a lot of coverage of stablecoins and what they can enable, et cetera. So we're going to dive into all of that. But first, I want to kick it off by asking you guys to introduce yourselves and maybe say a little bit about your project.
Thanks. Yeah. Hi, I'm Nevin Freeman. I'm one of the co-founders of a decentralized collateral-backed stablecoin called Reserve. The very quick version of Reserve, for your context, is that it's designed to be an independent cryptocurrency. So eventually, to go off of a peg. So it starts off pegged to the US dollar, in the long term becomes totally independent, and it's backed by essentially a really diversified basket of different assets.
Hi, I'm Vishal Gupta. I'm head of business development at Circle. We've recently launched the Center Consortium with Coinbase. It's a multi-issuer platform to create a stablecoin, which is the US dollar coin. We're excited for the debate.
My name is Stephen Becker. I landed at 2 a.m. this morning. I have construction outside of my hotel, and I've got a very strange accent. So this is going to be entertaining. But I'm the president. I'm the president of MakerDAO, and what we do is we have a stablecoin out there that is decentralized and effectively is just digital cash with no central point of failure.
All right, so why don't we start this off a little easy? What are some of the use cases of stablecoins, and how do you see that usage evolving?
I liken it to creating computers, in that there's a lot of things you can predict about how they're going to be used, and then there's probably a lot of many other things you can't really predict because it's so open. So some of the things that we can predict that we're excited about are, number one is basically people in economies where the currency is highly inflationary, being able to get their hands on something that is stable. It's very difficult to get your hands on stable fiat currencies in a lot of these economies for various reasons, and we think cryptocurrencies are going to sort of break down that barrier, and that's going to provide people, you have to imagine you're in a situation where your money's losing its value at maybe like 50% per year. You just don't have the option of saving in cash, whether it's in a bank or in the mattress. And if you can get your hands on a stable cryptocurrency, all of a sudden you have that option to save money, and we think that's like a really, really huge deal. There's something like 16 countries in the world that are having this problem right now. So that's one big case. Actually, I'll let you guys talk about some of the others because there are many.
No, I mean we agree with you. Obviously, that's a use case that's going to be really interesting over time, especially as we see countries look to use the US dollar as a stability in terms of currency. Honestly, the first use case is really trading for us, and we see it as a great ability to hedge out any risk in cryptocurrencies as well. But the hope is with time, as we find out which one of these stablecoins will actually work, you'll start to be able to build on top of that. You'll see payment systems, you'll see lending systems, you'll see things that will be able to be built on this foundation that we're all working on.
Not to be obscure, but basically you want to take a big step back and have a look at this and say, well, it's digital cash. So basically anything with transactional value is the use case. But from my point of view, what I'd like to try and visualize is where the blockchain is going to be as an economy in 5 to 10 years' time, and then say, okay, well, where are we from that aspect? Are we augmenting onto the traditional economy? Are we taking goods and services and sticking it onto the blockchain? Or maybe we're dovetailing. Maybe there's a hybrid approach. And in that, you're going to have goods and services sort of be flywheel produced and generated onto the blockchain. And from there, we've got all your use cases.
Yeah, and I think to dive a little bit deeper into that, there are the offline use cases, the payments, the store of value use case. But then I think something that I'm really excited about are the crypto native use cases, using the coin to go and bet on auger markets, or to go and interact with some of the rest of the open finance stack, whether that's insurance protocols or various decentralized exchanges, et cetera. And you need this stable token in order to be able to do so, right?
Yeah, yeah, and you know, the way I like to think about that is that in addition to being used inside of distributed apps that are like games or user, you know, sort of consumer applications, historically, if you want to create a new financial instrument, you're usually creating some legal agreement between parties, where it's like, if this happens, then money will change hands in this way. If this happens, money will change hands in this way. And that's all implemented on top of a legal system. And there's kind of this really cool, you know, kind of crazy experiment that's about to be run where it's like, okay, what if you don't need legal contracts to do that anymore? What if you can just write the code, have people look at the code and understand what's going to happen, and then have it, you know, move around these sort of fully decentralized digital units of currency? The process for innovating and creating different sorts of financial agreements like that actually could maybe speed up and explore a whole bunch of different things. And so we could see sort of different ways of moving capital around based on that new sort of code-based operating system instead of legal-based operating system.
Absolutely, and I also think that the stability aspect of stablecoins is really valuable as a transition mechanism in terms of getting people to adopt these Web3 products and really start interacting with various blockchain products, right? Because, like, I'll pick on Augur, for example, right? Like, I don't necessarily want to go and bet on the Super Bowl on Augur and also take on ETH price risk if I do so. What are some of the interesting distribution mechanisms that you guys have thought about to actually get your stablecoin out there in the hands of the people who either most need it or most want to use it? Is it more of a build it and they will come type methodology, or how do you make sure it's available to them and how do you get them to use it?
I mean, I think like one of our most focused debate internally is how to make this thing as stable as possible, how to de-risk this thing, how to make this thing make a lot of sense for not just us but the industry, and the multi-issuer format is what we came up with. You know, you're dovetailing fiat-backed with multi-issuer, with the ERC20 coin, with all the layers of the benefits of that, and you talked about it during your talk with Fred today. There's a lot of benefits to, you know, using something like ERC20. We're not entirely sure where this is going to go, but we are highly focused on creating something that people can believe in and build on for the future. So,
could you clarify, what do you mean by multi-issuer?
Oh yeah, so multi-issuer. So USDC is built on under a consortium called Center. Center's founding members are Circle and Coinbase. If you want to become an issuer, you have to be a regulated financial company. You have to send your monthly reports based on all your issuing docs and any bank statements for the US backed dollar coin that we have. So it's run by this consortium. It's not run by Circle. There's not a single point of risk, and we are looking to de-risk against things that we've seen in the market.
I'd actually like to extend my congratulations to Circle for the wonderful partnership with Coinbase. I mean, as far as the sort of stablecoin representation is concerned, you know, you're going to have that traction. You talk about use cases. In my view, once again, a little bit abstract, the biggest use case is your manifestation in the regulatory landscape. You know, how are you going to apply yourself where you've partnered appropriately? And if we can get a first mover that shows that, you know, this is how you can do it, this is how you can attract the attention in a positive way, well then stablecoins as a general space can be looked at and said, well, you know, what resonates with me? What do I want to choose to use for my DApp or for my particular circumstance?
Yeah, I mean, the one interesting thing about Circle is we believe the financial industry is moving towards the tokenization of everything, but we also believe that we have to sit on the rails of the existing financial regulatory system. So, you know, we have, you know, MSB, you know, money movement at 48 of the 50 states and 2 of the territories.
So to answer your question from a few minutes ago, we don't think about it as just build it and they will come. I think that we sort of break it down into adoption and initial network effects, and then also long-term staying power. So we're thinking about it in terms of how do we build something that's going to last for 100 years and stay stable for 100 years. And then also, how do we actually find the populations in the world that really will love this thing and will really get a lot out of it right now and bring it to them. So, at the beginning, as you mentioned, like right now, the main proven use case is people who are crypto traders. And so from that perspective, we're having a lot of conversations with exchanges. The target for any stablecoin trying to go to market right now is like, how do you replace Tether? How do you be the main base pair or quote pair on all of these different exchanges? And it comes down, I think, in part to the exchanges understanding, well, what is the proposition for this particular way of doing it? Why is this better than other ways? And perhaps how can they benefit from it? But really, it's like if you think about it from the exchange perspective, they want to acquire users. They want their users to be happy, and they want to make money on trading volume. And so over the span of the next year or two, I think a lot of it's going to have to do with what does the space really rally around? What do they get excited about? What causes them to say, like, yes, OK, this is where we want to place our trust. This is what we think is the future. And so from that perspective, what we've tried to work on is producing a token that is sort of obviously more financially trustworthy and stable than all the other options. And the very simple way that we do that is by aggregating together basically other currency-backed coins in a smart contract, and then substantially over-collateralizing that contract. So we'll announce the particular percentage right before launch, but for the sake of conversation, say it's 200%. And then what that means is that even if, so we might hold some of the Circle tokens, for instance, even if some portion of those projects default because of government intervention, for instance, or some bug in the smart contract or some counterparty issue, as long as that's less than like half of those projects, then the user still has 100% of their value. And we think that's a simple proposition that a lot of people in the space, especially traders who are moving huge volumes and market makers using huge volumes, can sort of see like, oh, well, why wouldn't I do that? So sort of that strategy coupled with just on the groundswell marketing campaign of like, we have to get people to understand it and be excited about it and see it as the future. That's kind of our take on how to get that going. And then one more thing I'll say is that this is just the beginning. I do think that those emerging market use cases are a really big deal. And again, those people aren't going to hear about this and adopt it by default. And so basically, we've been seeking partnerships with entrepreneurs who own large distribution networks already in those different countries, where if you look at the way that PayPal or something like that gets adopted, often it's by co-opting some huge existing network. In the case of PayPal, it was with eBay. And so that's the sort of model that we're looking to replicate within the stablecoins.
So I think all three of you hit on like a really interesting point here, which is on the trust in the stability, right? And I think that that's very relevant for the go-to-market as well, because the only way people will actually use your stablecoin is if it's actually stable, right? So I'd love to dive deeper into how you think about maintaining stability. How closely do you try to maintain the peg? How much volatility is actually acceptable in a stablecoin? I mean, recently with all the Tether drama that we've seen a lot of stablecoins break their peg to the upside just as Tether holders are fleeing into that stablecoin. So obviously there is some volatility that's occurring even in these supposedly stable coins, right? So like, one, how do you think about like volatility within your asset? And then two, what kind of steps do you take, or what kind of market incentive structures do you create to lower that volatility and bring in either arbitrageurs or other market mechanisms in order to maintain that peg? And maybe I think we should start with Maker and coming this way.
Yes, thank you.
I think you have some of the most interesting mechanisms already in place.
Yeah, we got that in place. So yeah, in keepers, but the first aspect I want to talk about is the underlying governing dynamics, right? Really as a case of looking at the traditional market, have a look at what we learned there from sort of underlying volatility arbitrage, which has sort of dynamic asset repricing, to look at option pricing, all the way through to exchange-traded funds. Have a look at what they use as a mechanism. We simplify it, and we basically brought it across. And that underlying dynamic is actually the thing that drives the market structure to make sure the arbitrage works. Now, given that, it's not a perfectly fluid mechanism. If it was perfectly fluid, I wouldn't be worried about much. I would just say the arbitrage is perfectly there, and that's how it's going to stay. So consequently, you have these frictions that are added into the mechanism, and those frictions will give you a sense of what the underlying bands you need to consider. Now, from economics, as soon as you hear the word peg, peg doesn't mean it's going to stick at $1 forever. Peg is a general term used to rather describe what algorithm you have in place. So it's either a banded one, or it's a full adoption of the currency, or there's some sort of hybrid in between. So from our point of view, it has to naturally have a band around it. So it really boils down to the fact of, what is the extent of that band stretch before you need to put the features in place that, bring back that stability. So that is the general thinking from Maker's point of view.
So you're willing to accept some volatility on the peg, but what are the actual market mechanisms? Could you describe maybe like how keepers function, or how CDP creation or destruction?
Absolutely, no problem. So what you got in the simple terms, you're going to have a cryptocurrency that you pledge as collateral. You draw DAI, and obviously you use it appropriately. You go into the market and you find, oh wait, look at that, DAI is trading above $1. What do, right? Your mechanism in place, given that you have a CDP, is to obviously, given that you want to get a CDP, is to go and put more collateral in, draw out DAI, because DAI is drawn out at $1, and you can sell it into the market at 104, 103, whatever the case may be. Likewise, if obviously the price of DAI is below $1, you obviously want to go purchase that DAI and go close your CDP, because you are purchasing at, let's say, 98 cents, but you are getting your collateral back at $1. So you have a natural arbitrage there. It's a very simple mechanism going back and forth. In fact, if you have a look at fiat-backed coins, it is just a lot more stronger there. If you've got, let's pretend for a moment, something like Gemini or Circle, it goes slightly above $1. It's very easy to figure out how to go and get that arbitrage in place. And it's probably a little bit quicker as well. I mean, the whole thing is pretty much centralized, and it's really easy to look at. What we're doing is we're saying, well, instead of getting that arbitrage just in dollars, you can get that arbitrage in any particular collateral that we're going to introduce in the future. So you can get that arbitrage in ETH. If you want to make ETH have a vector trajectory, or rather a liquidity trajectory into fiat, you could. Or when we come out with further collateral types, you may get your arbitrage in whatever those tokens may be. So it's really a case of what your numeraire is. What are you denominating your profit value in?
Got it. And so how do you think about this from the fiat-backed stablecoin perspective? Sure. And really, like, the main question that I would have there to dive deeper on what Steve was saying is, how tight is the loop for the arbitrage, right?
Sure.
Because the tighter the loop, or the faster the loop is, the lower the required return for for the arbitrager for any particular trade. And so then you can maintain a tighter peg, right? So how do you think about that mechanism?
I mean, first and foremost, I'd say we believe in the free market system. In saying that, the question is, how do you price out a fiat-backed stablecoin? And the way I think about it is, you have the dollar. It's sitting in a bank account that we trust. There's some utility to the coin, so there's some added utility on top of the dollar. And then there's risk. And those things fluctuate over time, and people are willing to put out a bid ask, and they're making markets in this. This is very similar to the traditional listed world that I came from. And that's how you price it. That's how we see it. We have an OTC trading desk. We own an exchange. They make markets there. We incentivize other market makers to trade with us, but it's a free market system.
Okay, so it sounds like there is a significant component here of using your balance sheet capital to help maintain the peg, and
it's limited. I mean, I should say it's limited. It's not just us, right?
Yeah.
And obviously we just launched it, so it's also we'll talk again in 6 months, I'm sure, and we'll have different answers. But yeah, it's not just us. We don't intend to prop this thing up one way or another.
You got to bootstrap the mechanism up to a point where it has critical mass.
Agreed.
Absolutely. So Nevin, would love to hear more about how you think about this from Reserve. And I know you guys are launching with it being fully collateralized, but then the ultimate vision is to no longer be fully collateralized and move towards more senior shares type model. And that's where I'm really curious about talking about the peg mechanisms, because for the collateralized, it's very similar. to what Steve and Vishal just mentioned about arbitrage, basically. And I think senior shares models have some of the most interesting and novel mechanisms to maintain the peg. So I think the audience would really love to hear about those.
Yeah, so we've actually had some innovations over the past several months since we last spoke about this. Mm-hmm. And so we've found a way to design our system where we can trend to one-to-one collateralization, not any less than one-to-one, and still have it be that the financial incentive for the secondary token purchasers is quite substantial. And be happy to go into that with anyone after this talk. It takes a while to describe, and I don't want to take all of our time. To answer your question, though, the way we think about sort of how tightly we want to hold the peg and how quickly to respond to fluctuations in market price, our broad perspective on this is that thinking about it from the perspective of the quantity theory of money is probably not the right way to think about it. That's like a good broad framework to think about the big economic forces. But really what you care about if you're implementing a stablecoin is impacting the secondary market order books as quickly as possible, because what is the value, what is the price? Well, in any given moment, people look at the markets, and that's sort of what the consensus price is. And so we think about it very mechanistically in terms of okay, if the price is a bit above or a bit below, what does our protocol have to do to allow arbitrageurs to step in as quickly as possible and impact those secondary order book market prices? And so essentially the way that works on a simple level is, if our token is trading at 95 cents, anyone can go purchase that token for 95 cents and trade it for $1 worth of collateral with our smart contracts pretty much at the same time, such that we think we can hold quite a tight peg to your point. And that's something that that will happen sort of probably every 30 minutes. So the idea of having a price diverge for many days while people make bank transfers and then go and sell tokens, we think that we can do something that's sort of much faster.
Okay, so something that or a framework that I found about stablecoins is you're trading volatility for blow-up risk, really, right? It's stable until it's not, and when it's not stable, it's not that oh, it holds at 90 cents. It's something really, really bad happened, right? And for collateral-backed stablecoins, it's an example would be the collateral is either no longer worth anything or worth far less than it needs to be, or it's been seized, it's inaccessible, or maybe in the case of a fiat-backed stablecoin, it's something that there was a court order that really has frozen that capital. How do you think about communicating this risk to your users? Because to users who come in and buy your stablecoin and they expect it to be stable, and maybe there's years where it's stable, but there's always this lurking blow-up risk. How do you think about disclosures and really making sure that your users are very educated about what they own?
Shall I start?
Yeah, go ahead, please.
Oh, sure. Okay, so we got black swans in the house, basically. Right, let's talk about them. So, effectively, there is the black swan of going to your bank, knocking on the door, and they say, sorry, you can't come in because we've got no money for you. And you sit back and you go, well, where's all my wealth gone? That's no. Unfortunately, I am from the sort of hedge fund world, and that is one of the things we constantly had to think about. What is that black swan? How do you protect against it? And ideally, what is the best way of going about this process? And what we found, and there's an association called GARP, the Global Association of Risk Professionals. They did an intense study, and they said, well, basically, the biggest risk you have to worry about, it's not market risk, it's operational risk. It's the court order coming in. It's Ethereum's fork that just goes wrong and something doesn't work. Those are the aspects we have to consider. So from that point of view, we've got to take a very broad look and say, well, ultimately, if you have something terrible happening on the Ethereum blockchain right now, we need to have a security module in place that says, okay, hang on a second. If something has gone awfully wrong, then everybody who has DAI will suddenly just have that collateral, as opposed to just holding that DAI. And then further to that, if you've got yourself something that is demonstrably broken with the whole system, well, lo and behold, you're going to go down with it. I mean, you can't look at black swans as predictable events. I mean, all you have to do is ask, Nassim Taleb, and he'll tell you very clearly that you can have if you can get yourself a decent long carry on a short position, you'll eventually pay out. So to that extent, what we got to do is mitigate for that kind of risk and say, well, how can we find those features and those ideas that will give us a sense that something is going wrong? And things generally have a way of transitioning into a black swan, and you don't know the extent of it, but you generally have some indicators. And if you are lucky enough to see them, you maybe can do something about it. And from our point of view, we have a security module in place that says, okay, something's gone wrong, the system shuts down. And anybody who has DAI, you get the collateral. It basically is like a complete swap right at that point.
Yeah, I mean, like the focus on consumer here and is important. People have to trust this thing before they're really going to use it beyond just trading it. And that's how we landed on multi-issuer. People should be able to look at us. They should be able to look at our partners. They should look at Center and the rules that bound it and understand how they should be able to trust it. And we see this as really the future of where stablecoins going. We believe that fiat-backed is very important. We believe that you shouldn't just look at Circle. You shouldn't just look at Coinbase. You should look at everybody who will join Center as an issuer as its future. And we're hoping that we're going to be the foundation for that.
So yeah, so I think you're looking to see like how do you get the users to understand what the risks are. Yeah. I think this is really tough. We've thought about this a lot from the regulatory perspective of, it's like if we're going to sort of go through the SEC's process of disclosing everything, the process isn't really designed for something like this. It's designed for a company that has cash flows and so on. And so as we've thought about that, we've kind of come to the conclusion that you need to think about the people that are going to be encountering this thing and their level of knowledge and kind of meet them where they are. Like probably like an explainer video that's like animated and like, shows like simple examples is much more meaningful than like a 50-page document that discloses everything about like the tail risks of this and that. And likewise, we've thought about should there be like a literacy test that you have to pass if you're going to participate in the thing early on or something like that. Maybe that would be much more meaningful than having this extremely detailed disclosure document. And so that's kind of the way we see it, is like, well, let's just think about who are the people, where do they get their information, and then how do we actually communicate directly to them about like, here's what you're holding, this is what it's made of, these are the sorts of things we think could go wrong, here's why here's what we do to have those not go wrong, but that this sort of gives you a sense of how it works.
Got it. All right, so I have the big kind of debate question is really on the trade-offs of the designs that the three of you have chosen, right? And so we sent out some reading to everyone in the audience describing various stablecoin designs. And really, there's this trilemma in stablecoins where you can have two of the following three. And everyone here has picked two of the following three. You can either be decentralized.
I beg to differ.
I think we'll all beg to differ.
Well, that's the debate.
Yeah.
So you can either be collateralized, decentralized, or scalable / capital efficient, basically have an incentive for supply to come online to meet demand.
And then just the fourth one would be privacy.
So I agree on privacy, although I think that's more of a problem for Ethereum and other smart contract platforms to solve.
Fungibility comes from privacy.
I completely agree. But my opinion would just be like, that's not like the smart contract layer doesn't need to solve that. You need to solve that at the protocol layer. So if Ethereum adopts something like zero-knowledge proofs, which we'll talk about later today, then like all of you get that for free, basically, if you're building on top of Ethereum. My first question is for you, Steve, on Maker. Maker is a system that I've personally been fascinated by for over a year. We've been researching for a while, and I have this really interesting question about, like, this is the first time that I've ever seen supply and demand curves that don't intersect. Because the creators of DAI in the Maker system are not incentivized to create more DAI as there's more demand for DAI, unless the peg breaks significantly to the upside, right? Like it being $1.02 doesn't really incentivize someone to create a bunch more. And so like to me, in my opinion, like Maker really fits in the decentralized and collateralized, but not necessarily. I don't mean scalable in terms of transactions per second.
Yeah, no,
I mean
size.
yeah, big size. Like so, like that's an interesting design trade-off. And then I see like from Circle, right? Like it's obviously not decentralized. There are clear disclaimers that you can go and freeze anyone's account at any time as per various legal orders, et cetera.
Do KYC.
Yep, exactly. And so that's a significant trade-off. And then it sounds like with Reserve, you're trying to really, you've evolved the approach, it seems, since we last spoke. But originally, the senior shares approach, the more classic approach, is not collateralized, however, very scalable in terms of you can create new stablecoin, and it's decentralized, right? So I would love to hear, from all three of you on like why did you choose those trade-offs, or why am I wrong about thinking that those are trade-offs that you've chosen?
When I first saw the title of this, the Great Stablecoin Debate, I was thinking to myself, what are we debating? Are we debating which one's best? Because if that's the case, then we sort of missed the point. Because it really is a case of participants lifting the fog of war on a landscape. And Nevin was good enough to actually share, and I will not be sharing with you, the white paper that he's written. And it is really, it's very novel, it's very well thought through, and I'm actually quite excited to see it implemented. When Circle got onto Coinbase, it became clear that this is getting traction. The point being is to sit back and say, okay, how does stablecoin as an industry move forward? Right? How do we do that with participants looking at each other going, okay, well, here's my manifestation. There's a regulatory approach. It's a clear approach. It's understandable and simple. There's a temporal effect on this where it becomes very evolutionary, where you sit back and go, fiat-backed makes a lot of sense. Once you've got that habituated and you start understanding that clearly, you go, well, what's next? Oh, decentralized. What does that do? Well, basically, it may solve the redemption risk that you have with fiat. That's great. Once you've got the decentralized, what happens next? Now, for me, nothing happens next. That's pretty much where it ends. But essentially, it's pretty much an evolutionary component that has one major input as a function, the breadth and depth of the economy that it basically operates on. So you look at open market operations. Why does it work? Why does the Fed do what it does? Because it's got this behemoth of an economy to put its teeth into. On the blockchain, we don't have that. It's not there yet. We still got to flywheel and facilitate the growth of the economy on the blockchain. So when you talk about demand and supply curves that don't intersect, well, there's your reason. You basically don't have enough to literally get your teeth into yet. And it is really the bootstrapping, the flywheeling, the generation of that economy is what we, I think as an industry, but from MakerDAO's perspective, are trying to facilitate.
Yeah, I think it's interesting. What we're doing here with stablecoin is actually very similar to what's happening in like the automotive industry, right? You're seeing something that's been used throughout history. It's been done this way for 100 years, and then you have someone like Tesla comes in and shows you the benefits of building an electric, semi-autonomous vehicle, and you see other competitors come in and you see them sharing in the same belief, right, as Tesla. And their focus is not to necessarily beat Tesla, but to just expand their world from the old world. And I think that we all look at each other as teams that we can call on and ask for help and try to derive strength from. We see a lot of benefit to the utility of like a stablecoin beyond the paper dollar. I think that this is definitely not a debate of whether or not we believe stablecoins should exist or why they exist or how they should exist. We're all going to find our different markets, and I think that hopefully we'll find strength with each other. So I mean, and I think we've all talked and we will continue to talk about how to work together.
Yeah, so I want to try to talk about each of those three properties that you mentioned and like what I think is hard about each one of those, like having it along with the other two, and sort of our thoughts on how to do that. So for let's start with collateralization. What's hard about collateralization and having it along with the other two? Basically, if you collateralize with cryptocurrencies, the problem with that is that they're volatile, right? If you collateralize with real-world assets, well, then the problem is that you have some connection between the blockchain world and those real-world assets, and that connection can be brittle, right? That's the issue there. And if you sort of have like the, quote, no collateral approach, or as I think about it, kind of having a secondary or multiple secondary tokens in your system that you use as collateral, well, those secondary tokens typically get their value from the future performance of the system, either transaction fees or growth or something, right? You could have like a share token or a bond token, et cetera. And then the problem with that is that, well, what if the market starts to conclude your system isn't going to be the one that's adopted? You could have a crash in the value of those tokens. So it's kind of like just the crypto collateral being volatile, but it's like especially correlated. You can have these downward cycles. So that's what's difficult about collateralization. And so, you know, after thinking through all these three different approaches, we concluded that actually collateralization with a bunch of real-world assets in a distributed way is actually necessary, we think. We think that the sort of promises of future income, there's too much risk of a downward spiral. And then with the crypto collateral, it's just still too volatile. The markets haven't actually consensed on what these things are worth yet. And so it ends up costing so much to have the degree of over-collateralization you would need to really rely on crypto collateral. And so once we settled on the solution of holding a bunch of tokens that are each themselves backed by assets, you know, issued by hundreds of different issuers all around the world in different political jurisdictions, we sort of concluded, okay, yeah, that actually could be a really robust system, and then you're importing the consensus value from those other real-world asset classes. So that's kind of what's hard about collateralization and what we settled on. For decentralization, we can relate that to the collateralization piece. So what's difficult about decentralization is you know, if you want something that is just on the blockchain, well, then it can't refer to these outside things at all, right? And so it kind of goes back to the piece of like, well, if you build something that's fully decentralized, then it kind of has all these properties of Bitcoin in the fullest sense. And that's really cool, and that's really tempting. And we tried really hard to find a way to do that that would be ultimately stable enough. But then again, the problem is that you sort of can't really effectively import that stability from existing asset classes. And then for scalability, so what do we mean by scalability here? Again, this is not the normal kind of scalability. We're talking about just being able to actually grow the supply of stable coins in response to demand, sort of as much as needed. And the issue with scalability usually comes in if you have some system that requires over-collateralization. And that's because, you know, if it's just one-to-one collateralization, then anytime someone wants a stable coin, they send some capital, you send them a stable coin, or your smart contract does, and everything's fine. So that can just go on indefinitely. But if you need to raise some extra collateral every time that someone wants a new stable coin, someone has to pay for that. And so then the question is, well, who pays for that, and how reliably can you incentivize the market to continue contributing that collateral? And so and this is a situation that Maker and Reserve are both in, where in the case of Maker, the idea is that people will contribute that collateral because they want to take a loan against it, which, you know, there are different reasons you might want to do that. One reason is that you can get leverage, a leveraged long position on that collateral asset. And so then, you know, when Tushar was talking about, well, the supply and demand curves are maybe not related, the question there is like, are there going to be as many people who want to make those collateralized loans as people who want stable coins? Our take on it is actually that people contribute collateral as a way of purchasing the future sort of income streams of the platform. So that way, if demand for the stablecoin is going up and the market is seeing like, okay, this might be adopted, well, that increases the expectation of the value of those future revenue streams. And so the idea is that people would want to purchase more of that, and in so doing, contribute more collateral. And so that scalability question comes down to, will the market actually want those secondary tokens, whether it's to sort of take that loan or to purchase that future income stream? And if it turns out that they don't, then we'll have trouble quickly scaling up the supply of stablecoins in response to demand. And so, you know, we've sort of thought about these three and tried really hard to find a design that actually has an overlap of all three. Because really, if you don't have all three, I think you can't really create a cryptocurrency that's really going to be massively adoptable worldwide and really serve the true purpose of cryptocurrency. And so, you know, that's kind of the endeavor that we've gone after.
Interesting. So I want to go deeper on that point. Like, what do you think the big, hairy, audacious vision for stablecoins can be? Like, how big can it get, and what kind of second-order consequences could there really be on either the crypto economy or the broader economy as all of your projects are successful and gain tremendous market share?
So do you mind if I take this?
Please.
So the way I see it, ultimately what we're talking about is the separation of currency and state. Like, if this really works in the way that we're perceiving it, we could just have currencies that are not operated by governments that are the dominant currencies in the entire world. And in the really long term, that's really powerful, we think, because as government institutions sort of degrade over like decades or centuries, that will inevitably lead to issues with the financial systems. And if you look at history, this happens over and over again. And so this is actually potentially a way to like upgrade the fundamental operating systems and coordination mechanisms that humanity is running on, so you could kind of switch from one empire to the next, like a new governmental system, without disrupting the economic activity underneath. So that's, from my perspective, that's the really big far-out vision. There's all sorts of things along the way that I think are quite beneficial in ways that people will be incentivized to adopt these things, but ultimately, that's, I think, where this is all heading.
Anything?
Completely agree.
So I've thought about this a lot, and like, I compare stablecoins really to Bitcoin adoption in a lot of cases, where people point at nations that are suffering from really high inflation, and they say, you know, see, here's where an Austrian monetary policy would really work. Here's where we need this sound money. Here's where we need Bitcoin, is in Venezuela or in Turkey or Argentina, typical examples, right? And to me, I see that the potential for stablecoins is really to go and bring the dollar to those nations in effectively a permissionless or easier to access, at least, way, easier to use, easier to store way. And like, I think like the biggest threat to Bitcoin and these Austrian these Austrian monetary policy coins, and also these evangelism-driven coins like Bitcoin or Monero, Zcash, et cetera, is really from stablecoins that come in and already have that user trust because they're borrowing the brand of the US dollar.
Well, essentially, as soon as you peg your currency to the US dollar, you are borrowing the monetary policy of that nation, so it's really baked in. To extend that monetary policy to places that may need it may not always be in their best interest, but it might be a short-term solution to revive a situation that is otherwise a critical place. So you may have the stability from euros. You may have the stability from SDRs, whatever the case may be. The point being is, if you bring that stability, it really is to be cognizant of the monetary policy that you bring with it and make sure that it is a reviving initiative, not a controlling or overtaking one. That's just my point of view.
Yeah, I agree with that. One thing I want to add here is that as we've gotten deeper and deeper into this project, we've realized the level of responsibility that's involved is really, really high, right? It's like we're talking about potentially creating this currency that, you know, that's initially pegged to the US dollar, and then eventually independent. But if we succeed, or some group like this succeeds in creating a currency that is worth hundreds of billions of dollars, and it's held by a lot of these people who are not crypto speculators. These are not people who are looking to make a quick buck. These are people who are just trying to not lose money, right? They're looking for stability. Yeah. They're trying to live. Yeah, it's money that they worked hard for, not money they got for free because they bought a token at the right time. If the peg breaks once that massive adoption has occurred, that's really, really bad for all of those people. That's much, much worse than like crypto markets going down a bit. And so, you know, from our perspective, and you know, as we've looked at a bunch of the designs out there, honestly, we think some of them are going to break. And so I think that there's a real risk both for those populations and then also for the cryptocurrency industry, right? Like if the first, you know, I sort of think that maybe the first huge real-world adoption of cryptocurrency proper is going to be one of these stablecoin designs. If the first experience that the world really has of that is a massive financial crisis, that's, obviously there's going to be a huge regulatory backlash, right? Like government bodies like the SEC are created in response to very bad things that happen where we're like, let's not do that again, right? So it could be that 10 years from now, there's a government body that's explicitly designed to stop people from creating novel currencies if they're not part of the state because of what happened the first time we tried it and fucked it up. So I think it's really, really important as an industry that we coordinate and think about the right ways of doing this. And it's like, kind of the way I think about this is, if you look at some of the designs, if central banks around the world were sort of throwing out these sort of random designs being like, hey, maybe we create a currency that's like this or like this or like this, like economists and government regulators would be like, are you insane? Like, no, you can't just go create currencies with all these weird designs and then try to get them adopted by like random people in other countries. And so we're at this weird moment in history where we don't, as a society, have a way of deciding who really should be allowed to do this and how we should judge what's safe to run as an experiment. And I think that we need to get, and this, sorry, one more thing. Yeah. So even if you're just a crypto investor, I think that really you should be trying to hire the best monetary economists in the world, because they're the ones who can look at these and actually understand them and see what's going to happen. We've had conversations with so many people, and most people don't get it, and a lot of monetary economists do get it. They're like, yeah, well, this makes sense, and this doesn't make sense. I think that those monetary economists are going to end up getting roped into the situation by people like me and other people in the industry, so we can try to coordinate and be like, all right, Binance, et cetera, let's not cause one of these things to be huge if it has a potential to break. And so that's something that keeps me up at night.
Yeah, I mean, I agree with Nevin. We have a lot of responsibility here in the stablecoin industry to make sure that things don't break. A lot of our focus is around risk. At Circle, we really we build Center because of that. We don't don't need single points of failure. We need to make sure that these things stay stable. People that are jumping into a stablecoin are not looking to invest in Ethereum or Bitcoin. They're looking to really just stabilize. I think it's we'll probably have to build forums. We'll have to get teams like us around a round table and really start to decide on things. We believe in the consortium model. We believe that everybody should have a say, and love to keep that conversation going.
Yeah, there's the sort of element of saying, well, there's all these frameworks out there around the world. You don't want to basically be orthogonal to them, but at the same time, you want to have something competitive that allows a transition of value, not just a substitution. I mean, I'm not going to go out there and say stablecoins are going to replace the US dollar. They're not going to go replace anything, but we certainly could find ourselves in a hybrid situation where we get the best of both worlds, and we can find a balance through some sort of competitive force. It may go Nevin's way, where it actually ends up being just one dominant universal stablecoin. If that's the case, well, that's the empire made. But to that point, a journey needs to be made, and one is you've got to confront the fact that there are very well-established people that have hundreds of years of effectively data behind them saying this is the way we should do things. And if we're going to create something that is just orthogonal to that, we're going to basically just come out with bloody noses. We've got to abstract it to the point where we say, how is it going to be made so that it is helpful and progressive at the same time?
Absolutely. So audience, we'd love to get some questions from you. I think there might have been some submitted through Telegram. So Matt, if you want to kick that off.
So question from Telegram. When will a sovereign government or state issue their fiat on a permissionless chain?
Tuesday. No, I have no idea. And the problem being is you might find it would be some of the sovereign states you wouldn't want to be on chain doing that first. So there's, again, a balance.
Well, I think the permissionless qualifier is what makes that hard. I think that a lot of them are looking into it, and I expect it to happen before too terribly long, actually. I don't know if it'll be permissioned or permissionless, though. But I just won't be at all surprised if it's sometime in the next year.
Who's it going to be?
Who's it going to be? That's a good question. I don't know.
Yeah, I mean, in terms of permissioned, I feel like the new approvals of regulated fiat-backed stablecoins is the first step in that direction, right? It's on a permissionless network, but there are permissioned aspects to it, right? Get another question?
Yeah, I just wanted to ask, as of now, with the evolution of stablecoins, we've seen a majority of them being used to move funds, either to purchase other crypto assets on exchanges. But I've always believed that cryptocurrency and the overall ecosystem will really grow when an employer is able to pay 10,000 employees in a cryptocurrency that is stable, because that will have a trickle-down effect. That employee will then have to buy their groceries with cryptocurrency, they'll pay their rent with cryptocurrency, wallet increases dramatically. So where do we start seeing actual stablecoins that can be used for purchases and for other more ordinary consumption patterns?
So I just to jump in here, I think that the network effects on a means of exchange are extremely intense. So even if you're paid in cryptocurrency, which some people are, if you work for some like crypto companies, you get paid in cryptocurrency, you go sell it for the fiat currency in order to pay your rent and buy your groceries and so on. And that will happen even if you're paid in a stablecoin for a long time. We think that the network effect on a store of value is actually not nearly as strong, because when you hold something as a store of value, you don't necessarily care if everyone else is holding that store of value or not. As long as there's liquidity, you can get it, trade it out into something else you care about. You just care about sort of the risk and the return profile of that store of value. And so I actually see stable coins being adopted broadly as a store of value first by people who don't have a stable store of value. And then once entire communities or the majority of people in a community are holding it as a store of value, then it starts to become a natural potential means of exchange. So that's the prediction that I have for how that would go. One caveat to that is that there are some projects who've thought about, well, how can we just like massively incentivize people to spend the thing, by giving, basically paying them to spend it, to giving them huge discounts. In those cases, I sort of predict that you'll see a bunch of usage because people are basically just being paid to use it, but people won't necessarily want to hold it. They won't want to go spend it on some other platform where they're not being paid to spend it. And then interesting question whether that will cause any network effect to set in or not. I personally think no, but that's an experiment that's going to be run like by a project called Terra in the Asian market. It's like, can you pay people to use it in e-commerce, and then will they just kind of out of habit start using it elsewhere?
I mean, you can see some of the network effects that happen with like Venmo, which was essentially like a fiat stablecoin. It just sat in a walled garden, right? My mom uses Venmo, right? And if you think about it, that's one of the first use cases of a stablecoin. We're just looking at some ability to allow that to escape the walled garden over time. Having people being paid on Venmo doesn't seem that crazy right now. You go out for a beer and you split it all the time. Things like this are happening. It's just taking what we learned from those payment systems, Circle Pay, and also now with stablecoins, we can start to integrate, and you'll start to see innovation in that space over time.
Yeah, I think the critical mass of store of value is very important, because from that, the infrastructure will wake up and say, okay, and how do we actually service this appropriately? And from there, you'll have people looking at, okay, well, my living standard can actually continue using crypto as opposed to always figuring out how to get onto fiat. It's almost like you need to give folks the option to realize they don't need it.
So as we discuss, real world opportunities, for stablecoins, will stablecoins be able to gain a serious usage without privacy of on-chain transactions? How do you think about that?
I think yes. I think that they will. I think there are huge populations that that either just believe that normal crypto assets are private or are not particularly concerned with privacy. I think that there is certainly going to be demand for fully private stablecoins, and this is something that our team has grappled with, where it's like if you create a zero knowledge proof type stablecoin, that potentially has bad consequences for the world. Like we're actually not convinced that would be a good thing to do. And so we're kind of exploring limited versions of that, where you allow people to transmit limited amounts of value fully privately, so that normal users can have that full privacy, but you can't launder huge amounts of money as like an international corporation or something. But I think it's going to be a central part of the regulatory conversation that crops up around stablecoins over the next few years. Is it's going to be trivial technologically to make them fully private. And some projects are no doubt going to do that, and I personally think that they'll end up being outlawed.
Yeah, I mean, I think that this is an example of people taking many different views on stablecoins. I mean, at Center, every Center member has to do proper KYC AML for any onboarding, offboarding on fiat, and it's super important for us because it's another way to de-risk. And again, our number one focus is to de-risk for us.
The only thing I worry about is the sort of, how to put this, sort of the decommoditization of the currency, because you attack the fungibility. You start creating separate assets because of either jurisdictions or regulatory impact, and that might slow down the adoption a little bit. So that's really just always been my concern from a fungibility point of view.
Absolutely.
So,
Yeah.
So thus far, we've seen the most demand for Tether out of any of the stable coins. 5 years from now, 10 years from now, do you think there will be more demand for a decentralized, unregulated stablecoin?
May I ask you a loaded question? Define demand for Tether.
I don't want to get into that right now. So yeah, ignoring that part, do you think in 5 years or 10 years from now, there will be more demand for a decentralized, unregulated stablecoin or a centralized, regulated, fiat-backed stablecoin, and why?
Sure, punch right to the gut.
Yeah, I mean, we made an obvious bet on fiat-backed and highly regulated, and there's many reasons why, and I don't think I have to repeat myself, but that's where we see the future of it. But again, there could be many winners in this space, and we should all be sitting at the same table.
I think there's going to be, as I did mention previously, you're going to have right now the sense that everyone is grappling over some half-eaten apple at the banquet table, which is kind of ridiculous.
Yeah.
And it really is just a case of turning around and saying, there's actually enough landscape to have all of this enter into the economy and actually be used bespoke and with specific unique features that resonate with certain folks to achieve whatever they want to achieve. So can there be a decentralized, unregulated? Most probably, because you might find that the on-ramping has to be regulated. It's really a manifestation of how there's regulatory points of impact and what did the gentleman in the previous, in the first conversation say, attachment points. That's really where the really interesting part is. You can have a deregulated, decentralized coin, just as long as you get there, it's being looked after appropriately from a jurisdictional point of view.
Yeah, the way I see it is that with the centralized regulated stable coins, there's the AML KYC check on the way in, but then anyone can get a key and hold those tokens and send them around to anyone else. And if you have a good enough OPSEC, that is anonymous. And so I think it's a really interesting question. How is FinCEN really going to feel about that in the long term, right? It really is, once they're in there, they're like Bitcoin, but they're stable in price and you can treat them like normal money. What are the implications of that? So when my personal estimate, who knows if this is right, is that ultimately you'll have to go through a KYC process to get any one of those keys. You'll have to be on a whitelist to hold the tokens at all, not just to issue them or redeem them. And I still think that that can be a great product because it's kind of like a bank account but substantially more open where you can just send your balance to anyone else. And I think that there's going to be huge demand for that. I think it's a very different thing. I sort of think of that as an open bank account, and then I think of this other decentralized stablecoin approach as an independent currency that's kind of like Bitcoin, but has a stable value. And so it depends on who you are and what your preferences are, whether you'll choose one or the other. I kind of think there'll be more demand for the sort of like truly independent currency that you don't have to go through a KYC process for, but I don't know. It's really hard to tell. But they're certainly serving very different populations, right? It depends on where you are in the world, whether you care about self-custody, whether you care about being compliant with the US government and banking system. And so we focused a lot on, for instance, like people in Argentina, they really don't trust the banking system. Because in 2001, essentially, like 3/4 of their money was stolen from them. And so, like, self-custody is like actually a really big deal there, right? Those are people who are holding cash in their homes or in like physical vaults. And so, the idea of holding a crypto asset where you really do just hold the money, you're not holding a key that sort of could get detached from the money somewhere else. We think that's a big deal. So I think both. It's hard to tell which is bigger. And it kind of comes down to like how that legal situation shakes out, I think.
Last question from Chris.
So, so if you rewind the clock a few years ago to the Great Recession, right? The one lever that all developed economies pulled was around monetary policy and opening up the printing presses. So kind of with that as a backdrop, why would any sovereign entity allow you guys to exist, assuming you aren't fiat backed?
I mean,
Assuming
we're
you
fiat-
fiat back.
I didn't hear the question clearly, honestly. Like, can you say it one more time?
Sorry, so Great
Yeah.
Recession.
Yeah.
Right? Everybody created printing presses. They just wanted to essentially like have an additional monetary supply.
Right.
They could stimulate the economy. So if you guys ultimately like become the stablecoin and take away their ability to manipulate monetary policy, like why would they ever give up their right to essentially?
Well, this goes to the point of saying earlier that we've got to try to figure out an abstraction that doesn't have any orthogonality towards the monetary policy of, for instance, in the Great Recession, the U.S. Because if you do, you're just going to be antithetical to them, and as you don't have a competitive point of view where you can balance off, weak points, where you can actually move from the traditional economy into this digital one and say, listen, those CDOs, I'd rather go over there because I can see transparently what is in them, how they're formed, and who they've been sold to. So it really just boils down to a competitive point of view, not necessarily an aggressive overtaking one. Sorry to
No, I mean
swallow up your...
it's a layer on top of their policy, and I at this point I don't see any reason for them to push back.
There's like the narrow version, the broad version of your question. The narrow version, I think, is that in that instance, as I understand it, there was essentially a need for much more liquidity in terms of the volume of the currency, and so a lot more money was printed. If you have a stable coin system where as demand for liquidity goes up and thus demand for currency goes up, the system automatically responds by creating more units, then you could actually have a sort of smooth quantitative easing response even with that rules-based monetary policy that's implemented on the blockchain. So it could be that for that particular instance, it would be fine. But then there's still the broader question of like states like being able to print money. It's very useful, right? Like would they want to give up that power? Like, well, obviously not. And so I don't think that this is going to be like a nice thing where like, hey, should we do this? And they're like, yeah, let's do it. And we're like, okay, great. That's not what's going to happen.
Nobody likes to be disrupted.
It's going to be rough. Yeah. I think that the thing is that it's not going to affect the U.S. for a long time, if ever, right? Like, and so we're really not talking about like the Fed. We're really talking about central banks in these smaller, like much more poorly run, to be honest, countries where the thing that's kind of at stake for them often has to do with their personal wallets, right? Like there's a lot of corruption there, and being able to print money is useful for sort of the populist cycle of providing lots of services and overspending to get reelected and actually like laundering money out of the system and so on. And like I feel pretty okay about going up against that and maybe not being able to travel to those countries starting in a few years. Like that's kind of how I see it.
Awesome. Well, thank you, everyone. And thank you, everyone, for your questions. Appreciate it. Thanks.